Dow futures moving up this morning. Investors waiting for the key interest rate decision from the Federal Reserve this afternoon. The central bank is widely expected to raise interest rates, and if it does, it will be the 9th such move since December 2015 when this tightening cycle started. Here now is Altium Wealth Portfolio Manager, Market Strategist Michael Lee. Mike, tell me something I don't know that might happen this afternoon, whether it's the rate decision, but the statement and then the press conference afterwards.
I think we get 25 basis points. I don't know how dovish or hawkish the statement is going to be, but I think a lot of people, and I think the market is getting this wrong. I think we need to raise rates. We need to move to a path of normalization, and I would say we'll be normal when we go into a Fed meeting when there's an equal odds of a rate raise and a rate drop. So when you have a 50-50 odds of either a hike or a cut, then we'll be normal. I think we're a long way away from it. I think if you keep rates too low for too long and you get obsessed with it, it pulls growth down, and I'd say Japan is your model for that.
Hey, Mike, how you doing?
So, I'm going to push back on a lot of that, but continue.
So, I guess the question is this. I think the market is now expecting that the Fed's going to pull back the reins, even if they raise today. What would the markets like the best? What's the best case scenario for markets in terms of the tone coming out of this? Is it more dovish? Is it more balanced? Is it more hawkish? Should they talk a little bit more about market volatility and how that's a factor and how trade's a factor? Should they get more, for lack of a better way to put it, multidisciplinary rather than just saying it's about the data?
You know what? I don't think so. I think that's a slippery slope, and Jerome Powell's in a kind of situation where you're damned if you do, damned if you don't. Because if he raised rates, it's like, oh, well, why'd you raise rates? And if he doesn't raise rates, it's what do you know about the economy that no one else knows about? We have been too low for too long. We're now back where we were on the Bear Stearns crisis, and in addition to that, we have a $4 trillion balance sheet. So you can say we are now.
You mean back to the short-term, the federal funds rate?
Yeah, Fed funds rate, and plus we have a $4 trillion balance sheet. So you could say we're more accommodative now than going into the depths of the financial recession. So I think they should stick to their knitting, be data dependent, and if there's additional volatility, eventually the market will get over it. We have a strong economy, and as rates are going higher, savers are starting to make money. There's a lot of cash on the sidelines. The savings rate is still up near 7%. A lot of these people are going to start making money, and I'd say this path to normalization is inflationary.
Right. Do you think the president's tweets or his pressure, on the Fed will have any impact on the decision today?
I imagine that has made Jerome Powell's job substantially harder, right? And then maybe other presidents have put just as much pressure on the Fed in certain circumstances.
Not publicly, privately, exactly. Which maybe is more insidious than disruptive than saying something publicly to the American people. Wouldn't you rather have President Trump talking to the American people? He's a real estate guy talking about I don't like higher rates, rather than being an Lyndon Baines Johnson or Richard Nixon and basically jawbone and the Fed chiefs behind closed doors.
Jay Powell has cover right now to pause and not hike rates this afternoon. And it came from Kevin Warsh and Stephen Druckenmiller, that op-ed in the Wall Street Journal earlier this week. Basically, these are very brilliant men with experience and skin in the game saying the market and the economy can't handle a pause. And I think that helps. Do you think that helps Powell maybe not look like he's caving to political pressure if he does decide to not hike today?
So if he doesn't hike and then he's more hawkish right now, he gives himself cover. If he hikes and he's very dovish, he gives himself cover. But I think they just the Fed needs to stick to their knitting, right? They need to be data dependent. They need to be focused on inflation and unemployment.
But look at the data. Auto stocks are down 30%. Building stocks are down 35%. Banks down. Russell 2000. Small cap companies that are supposed to be immune to trade. They're in a bear market.
So a couple of great things we touched on there. So the autos overproduced in 14, 15, 16, and 17 for that matter. And so they flooded the market with supplies, and they've done that with too easy financing, right? So anybody can get a car loan, and there's some real problems with that.
Subprime, there are real problems in subprime lending there.
And then overinflating the back-end values on leases. Okay, housing prices, we're off on housing prices, we're off on home building stocks, but that's only because we just hit all-time highs in the housing market a year ago, and so if we have a slight pullback from that, you're going to see a supply-demand.
So what Mike's saying is to paraphrase in my country sort of way, that it's not the Fed's job to rescue these industries.
Absolutely
It
not.
is the Fed's job. What is the dual mandate? Stable prices and low unemployment, and the balance of those two.
Yeah, and what really irks me is the yield curve. If the Fed is worried about yield curve inversion, why don't they just sell $1 trillion worth of long bonds, right? It's not. So to the bank stocks, and if they're really worried about it, you know, what might be smart is maybe we pause on the rate hikes, but we go through massive balance sheet reduction in 2019.
So is that possible? You think that they go, because right now they're reducing the balance sheet at $50 billion a month, that they up that amount? Because Stephanie Pomboy is coming on later, and she thinks that the unexpected is that they stop reducing the balance sheet in the next year potentially, or pull back from what is called quantitative tightening.
Yeah, so I don't believe in that concept of quantitative tightening. I think we've overinflated some asset values. I think this build of the balance sheet to where we are was a mistake. And Stephanie Pomboy's points, like there's a lot of debt that has to be refied. Well, number one, does it need to be refied? Because if you look at debt to assets, right, and cash on corporate balance sheets, it's huge. But if it's cheaper to go out and borrow at 1% or 2%, where you have a functioning capital markets, where it's really cheap to borrow, then hold our cash and hold our assets. So.
Before we move on, so you think the Federal Reserve raises today? What does their statement, what do you think they do next year in terms of just the short-term rate hikes? How many next year? 1.25, 3, 2?
I think that'll be data dependent. If we do have an accelerated slowdown, we have estimates out there for high 1% GDP next year, all the way up to just around 3%. So what happens? I tend to think next year is going to be better than a lot of expectations, because if you look at the tax cut that we just had, it's not your typical tax cut. It was more tax reform. It's become completely different the way we do business in the United States based on our corporate tax rate and the deregulatory environment we've ever had. And that kind of leads me to my next point, can this be the end of the business cycle? I don't see the frothiness. I don't see the end of it. We just had the largest fiscal stimulus in history, largest deregulatory event in history.
But one of the problems is the business spending. The business spending has not picked up and not grown in the way that a lot of people expected with the tax reform, and some people will argue it's our trade policy that's getting in the way of that and fomenting uncertainty.